In the winter of 2001, Enron Corporation was the seventh largest company in America. Its stock traded at $90 a share. Fortune magazine had just named it America's most innovative company, 6 years running. Then, in 24 days, it was gone. $60 billion in market value evaporated. 20,000 employees lost their jobs, their pensions, their savings, most of it locked in company stock they'd been told to trust. Investors lost an estimated $74 billion. It remains one of the largest corporate collapses in American history. The men who ran Enron weren't street con artists. They were Harvard MBAs, award-winning executives, the architects of what Wall Street called financial innovation. Jeffrey Skilling built a culture where employees were ranked and fired by the bottom 15% every 6 months, a system so brutal insiders called it rank and yank. Andrew Fastow built something else entirely, a web of off-the-books partnerships designed to hide billions in debt from investors, regulators, and Enron's own board. For years, it worked, because the fraud wasn't hiding in the shadows. It was hiding in plain sight, buried inside footnotes, approved by accountants, signed off by lawyers, praised by analysts who never asked the one question that mattered. How is this company actually making money? By the time anyone asked, it was too late. This is the story of how the smartest men in the room built an empire on lies, and how almost none of them ever really paid for it. To understand how Enron built the largest accounting fraud in American history, you have to understand what Enron actually was, because by the end, almost nobody could answer that question clearly. Not the analysts, not the board, not even most of the employees. Enron started in 1985 as a natural gas pipeline company, formed from the merger of Houston Natural Gas and Internorth. Pipelines, physical infrastructure, moving gas from one place to another and charging for it, a business a child could understand. That is not the company that collapsed in 2001. Under CEO Kenneth Lay and later Jeffrey Skilling, Enron transformed itself into something almost impossible to define. A trading company that bought and sold energy contracts, weather derivatives, bandwidth futures, even the rights to future weather patterns, more like a hedge fund wearing an energy company's name than a utility. Skilling, a former McKinsey consultant, pushed for something called mark-to-market accounting, a method that let Enron book projected future profits from a deal on the day it was signed, not the day the money actually arrived. If Enron signed a 20-year contract projected to earn $500 million, they could report that $500 million as profit immediately, regardless of whether the deal ever performed as projected. This one accounting decision, approved by regulators in 1992, is arguably the single most important fact in the entire Enron story. It meant Enron's reported earnings were not a record of money made. They were a record of predictions, and predictions can be adjusted, inflated, and eventually invented outright. By the late 1990s, Enron was the seventh largest company in America by revenue. It employed over 20,000 people across offices in more than 40 countries. Fortune magazine crowned it America's most innovative company for 6 consecutive years. Wall Street analysts issued buy ratings almost universally. Business schools taught Enron's trading model as the future of the American corporation. Nobody was asking the obvious question. A company built on predicted future profits needs those predictions to keep coming true, forever, without fail. What happens the moment they don't? That question was about to have an answer, and the men in charge of Enron had already built the machine that would hide it. Every fraud needs an architect. Enron's was Andrew Fastow. Fastow joined in 1990 from a banking background in securitization. bundling debt into tradable products. By 1998, Skilling made him CFO, the youngest at any Fortune 500 company. His job wasn't managing Enron's money, it was making problems disappear. And Enron had one. Mark-to-market accounting created profits on paper, not cash. The company was reporting record earnings while quietly drowning in debt from deals that hadn't paid out. If that debt hit the balance sheet, the stock price would crack. Fastow's fix was the special purpose entity, a legal structure meant for narrow, limited uses. He weaponized it. Dozens of entities, with names like Chuco and LJM, built to buy Enron's bad assets and bury its debt off the books. Here's what regulators missed. Fastow himself controlled many of these entities. He was Enron's CFO, negotiating deals for the company, and simultaneously, the owner on the other side of those same deals. Every transaction he approved could personally enrich him. The board approved it twice. Arthur Andersen, Enron's own auditor, signed off year after year. Nobody looked closely enough to see a CFO who had built himself a private empire funded by the company he was supposed to protect. By 2000, Enron's stock hit $90 a share. On paper, it was one of the most successful companies in America. In reality, it was running on borrowed time, and borrowed money it wasn't reporting. The special purpose entities weren't just hiding old bad deals. They were actively enabling new fraud in real time. When one of Enron's investments lost value, a broadband venture, a power plant overseas, a trading position gone wrong, instead of reporting the loss, Enron would sell the failing asset to one of Fastow's entities at an inflated price. The entity would pay for it using Enron's own stock as collateral. Enron got to report a sale instead of a loss. Fastow's entity now held a bad asset it couldn't actually afford, propped up entirely by Enron shares that needed to keep climbing in value to cover the difference. This created a trap with a single point of failure. As long as Enron's stock price kept rising, the collateral covered the debt, and the illusion held. The moment the stock dropped, the entire hidden structure would be exposed simultaneously, because dozens of these arrangements were all wired to the same failure point. Executives knew the risk. Internal emails later uncovered by investigators showed employees referring to some deals using nicknames like the biggest haul of mirrors in history, an acknowledgement that many involved understood exactly what they were building. Enron's own accounting was so aggressive that even routine business units were pressured to report growth that didn't reflect their actual performance, because the entire company's valuation depended on an unbroken chain of good news. By the time Skilling abruptly resigned as CEO in August 2001, 6 months into the job, citing personal reasons, insiders were already selling their stock quietly. Skilling alone sold shares worth millions in the months leading up to the collapse. Employees, still told the stock was a safe long-term investment, kept buying with their retirement savings. The machine Fastow built wasn't just fraud, it was a countdown. And by mid-2001, that countdown was almost out of time. Why did nobody stop this? Not the board, not the auditors, not the analysts covering the stock every single quarter. The answer isn't just greed. It's a set of psychological blind spots that Enron built its entire culture around exploiting. Start with authority bias. Jeffrey Skilling was a former McKinsey consultant, widely regarded as one of the smartest executives in American business. When someone with that level of credibility says a complex financial structure is sound, people default to trusting the expert instead of verifying the math themselves. Enron surrounded itself with the most prestigious names available. Arthur Andersen for auditing, top-tier law firms for compliance, blue-chip banks for financing, and every one of those names functioned as a stamp of legitimacy that discouraged scrutiny. If the smartest people in the room say it's fine, who's going to argue? Then there's complexity as camouflage. Enron's trading structures, hedging strategies, and special purpose entities were deliberately, almost absurdly complicated. Even experienced Wall Street analysts admitted they couldn't fully explain how Enron made its money. And rather than treating that confusion as a red flag, the market treated it as innovation. Confusion was mistaken for sophistication. Inside the company, the culture reinforced silence. Skilling's rank and yank system fired the bottom 15% of employees every 6 months, creating an environment where raising concerns about accounting practices could look like disloyalty or incompetence and get you marked for the next cut. Employees who noticed irregularities learned quickly that asking questions was a career risk, not a virtue. And employees trusted the same story investors did. A company that Fortune magazine had named most innovative 6 years running couldn't possibly be a fraud. People don't expect collapse from companies wrapped in that much institutional praise. That expectation is exactly what let the fraud run as long as it did. Here is the part of the Enron story that gets lost in the accounting details. This wasn't a victimless crime. It had a body count measured in ruined lives, and at least one death directly tied to the collapse. Employees were encouraged, in some cases effectively required, to hold Enron stock in their 401k retirement accounts. Company matching came in Enron shares. Financial advisors within the company promoted it as a safe, growing investment. As the fraud unraveled in October and November of 2001, employees were locked out of selling their shares during a blackout period tied to a retirement plan administrator change, a period that conveniently coincided with the stock's final catastrophic plunge. They watched their retirement savings evaporate in real time, unable to sell, while executives who knew the truth had already cashed out months earlier. 20,000 people lost their jobs. Many lost their entire retirement savings simultaneously, a double blow that left families with no income and no safety net at the same time. J. Clifford Baxter, a former Enron vice chairman who had internally raised concerns about the company's accounting practices and had resigned in protest months before the collapse, died by suicide in January 2002 as investigations into the company intensified. He left behind a wife and 2 children. Arthur Andersen, one of the 5 largest accounting firms in the world, was convicted of obstruction of justice for shredding Enron-related documents. The firm collapsed entirely, taking 85,000 jobs worldwide with it. Auditors, accountants, and staff who had nothing to do with the fraud itself, punished by association for the actions of a handful of partners who signed off on Enron's books. The fraud wasn't contained to boardrooms and balance sheets. It reached into households, retirement accounts, and in at least one documented case, cost a man his life. By December 2001, Enron filed for bankruptcy. At the time, the largest corporate bankruptcy in American history. $60 billion in market value gone, 20,000 jobs lost. Investors out an estimated $74 billion. Here's the part that should outrage you more than the fraud itself. Almost nobody went to prison for it. Jeffrey Skilling was convicted in 2006 on 19 counts, including securities fraud and conspiracy, and sentenced to 24 years, later reduced to 14 after a resentencing deal. He was released in 2019, having served roughly 12 years for a scheme that cost tens of thousands of people their savings. Kenneth Lay, Enron's founder and former CEO, was also convicted in 2006, but died of a heart attack before sentencing, and under federal law, his conviction was vacated entirely. Legally, he died an innocent man. Andrew Fastow, the architect of the fraud, the man who built the entities that hid billions in debt, cooperated with prosecutors and served just over 5 years. Arthur Andersen was convicted, then had that conviction overturned by the Supreme Court in 2005 on a technicality, 5 years after the firm had already collapsed and its employees had already lost their jobs. No major bank or law firm that enabled the fraud faced criminal charges. Some paid civil settlements. None of their executives went to prison. The system that was supposed to prevent this, auditors, regulators, boards of directors, didn't just fail to catch it. It got paid to look the other way and walked away largely intact. Enron didn't just cost people money. It exposed something uncomfortable about the system meant to prevent this kind of collapse. The accountants who are supposed to catch fraud can be paid by the very companies committing it. The regulators who approve accounting methods can be the same regulators who fail to question them for a decade. And the executives who cause the most damage often have the resources and legal teams to walk away with the least consequence. In direct response to Enron, Congress passed the Sarbanes-Oxley Act in 2002. New rules requiring stricter financial disclosure, harsher penalties for corporate fraud, and greater independence for auditors. It was supposed to make another Enron impossible. It didn't stop the next one. Because the truth is, Enron wasn't a uniquely evil company run by uniquely evil men. It was a system working exactly as designed, rewarding short-term stock performance over long-term honesty, rewarding complexity over transparency, and rewarding the people clever enough to exploit both. Change the names, change the decade, and the same mechanics show up again. And again. Next time on the Dark Ledger, a Ponzi scheme so vast, so audacious, that it fooled federal regulators for over a decade and destroyed thousands of lives before a single arrest was made. The smartest men in the room built Enron. The next story is about the man who convinced the whole world he was one of them.